Hey, welcome to how the energy market has changed. The old rules don't apply. If you're trading oil, if you're trading natural gas, if you're trading any energy product, this video is for you. If you are producing and selling your product or consuming your product, this video is also for you. This is a matter of the old rules don't apply. The way that oil and gas markets used to trade in the old school way have changed. Technicals have become a driving force. AI has become a driving force. International relationships on natural gas has become a force. Geopolitics, tariffs, all of this comes into play. So what we're going to talk about today is we're going to talk about what has changed and what you can do to fix it, and really understand a little bit more about the energy markets so that you can take action, whether you're trading the commodity, whether you're selling the commodity as a producer, whether you're buying the commodity as a consumer. So OPEC Plus doesn't always follow its own script. Okay, that is important to understand. Alongside, supply chains are now global but unstable. It's part of the reason that when there's geopolitics around the Middle East provides so much oil to the rest of the globe that it becomes a very important factor in international markets. But the other thing is the sensitivity. We have 100 million barrels a day of global supply and demand, a little bit more than that, maybe 105. Kazakhstan is overproducing their quota per OPEC plus, or their target, or their supply target, by say 300,000 barrels a day. 300,000 out of a 100 million barrel a day market, and that moves the price by 5% plus or minus. These are big, big variables. So the sensitivity on 100,000 barrels a day or 200,000 barrels a day, it makes a big difference. Demand signals out of China, out of India, out of Asia, these also trigger concerns about recession fears, geopolitical shocks. So these are providing fuel for volatility. So traders are facing whipsaws, and we are headed up, we are headed down. We can look at that just in this past week, where we went all the way down to 57.74 and then launched back up to 61.64. Natural gas is having its own volatility, and it looks to be pointed down at the moment, but more on that later. So traders are facing whipsaws, and if you're selling your commodity as a producer, this impacts your bottom line. If you're buying the commodity as a consumer, this impacts your bottom line. These markets matter, and you should be following these and paying attention to them. How? I'm going to show you. So we'll cover that a little bit later. Policy shifts, carbon, ESG, tariffs, these changes are happening all the time, and these changes are driving the market up and down, up and down. And part of the reason that we went down, for example, when we look at crude oil, when we went down, it was because of tariffs. So when we were in this range and we went all the way down here, it was because of a broad reaching tariff policy out of the US. So you can talk about the merits of whether it should or whether it shouldn't. It doesn't really matter. It's going to impact the volatility. So if you're selling the commodity, it is now impacting your bottom line. If you're buying the commodity, it is now impacting your bottom line. So OPEC Plus is finally bringing barrels back into the markets. Why the impact might be calm? Well, most of these barrels are already in circulation. And if you're not aware or tracking the numbers here, this matters because you're going to be chasing a news headline and trading a position, or aligning your sales based upon, oh, they're bringing more barrels back, so let me put some more barrels into the market quicker before the price drops. Well, the fact is most of those barrels are already in circulation. So is this just a market overcorrection? Is supply and demand really triggering a downdraft that fundamentally we should be a little bit higher? These are some of the questions that you should be thinking about. Saudi Arabia is searching for a balance, but have they already achieved it? These are questions that you should be asking, especially in the oil markets. Is it going to change this summer? Will the prices stay stable in the $60 to $70 range? Are we oversupplied? Are we undersupplied? Why should you care? Because as we discussed earlier, 300,000 barrels or less than 1% of the market can drive prices by 5%, sometimes more, up to 10%. So these become very important factors to be watching. So is this the perfect storm for price instability? Not stability, but price instability. It is. The answer to the question is it is, and all of it matters. So OPEC Plus seems to be managing a delicate fight without fighting approach on establishing a price range because most of the OPEC Plus nations do want oil prices at a higher price because that helps their budgets because as they're exporting so much crude oil that becomes their income so they want a higher price but if they pump all the oil that they're capable of pumping it could have a downward effect on price which then has a muted effect of they're producing more but making less. So it's a profitability factor. So why will this hold through the rest of the year? These are questions, and these are going to change throughout the year. OPEC Plus is signaling the strategy for the rest of the year. And if you haven't been listening, you should be because it is going to impact oil prices in a big way. It is going to impact gas prices in a big way. So there's a lot of dynamics that are changing every single day. Expect volatility. Small changes could cause big ripples in Brent and WTI prices. As we discussed with Kazakhstan, as an example, 300,000 barrels a day or 0.3% of the market is moving the price by 5%. So this becomes a very important variable, and it's important to stay tuned every single day. So volatility is not a bug. It's a feature. It's the new normal. We're having 5 to 10% price swings, and that becomes common. Equities, oils, and currencies are all intertwined more than ever before. Liquidity is thinning. Okay, that's important to understand. That means fewer players are playing the game, which means you're going to have more rapid, sharp price changes to the upside and to the downside, making the price action faster and more extreme. Then you have headline risk, OPEC meetings, Fed moves, LNG sabotage, Middle East conflict, and these can change in a matter of seconds. And these have been changing in a matter of seconds just throughout this year. This has been a turbulent 4 months into 2025. Since January, we have had a turbulent 2025. So let's actually take a quick look at that, and we'll go to 1 week, and here we go. And here is 2025. It's been turbulent. We started the year, we went up from the 60s to the 80s, back all the way down to the 50s, and now we've stabilized in the 60s. So these are important factors to watch. So the problem, most traders, most producers, most consumers, they're playing a guessing game. They have no strategic framework, generic headlines. They're missing real signals. The strategies that they have are more reactive in nature. They're always one step behind. In other words, OPEC Plus announces something and they're already behind the 8 ball. So they're lagging data. They're using yesterday's information to make decisions about tomorrow. So traders, producers, consumers are missing signals from CFTC flows, AI trading footprints, macro and fundamental divergences. I mean, ultimately, the challenge is you have to be watching everything at once all the time. So there is a trading resource that we have provided, and it provides a global market summary, key fundamentals, key technicals, OPEC intelligence, CFTC, economic news and rundown, and machine learning and AI models. And we have put this into, I'm going to show crude oil first and then showed natural gas. This comes out every single day. We have this that talks through fundamental analysis. So when we look at technical analysis, all of this is contained in here. You got a market summary, which includes a technical outlook, which shows bearish, moderately bearish, international prices where they are, crude stocks, and net imports. Those are key variables for the US. The news sentiment, which is currently neutral. The net position, this is the spec positioning, and they've gotten slightly shorter, but you can step through this and in a quick glance go, technicals are leaning bearish. Now, which ones? Moving averages are bearish. ADX is bearish, but bullish on MACD and stochastic. We break it out because you may have a different position as far as saying the stochastics you trust a little bit more. And currently, the stochastics would have been probably paying off well. So then fundamentals. What is the crude production, imports, exports, refinery inputs, all of this at a glance. You have the current week, last year, and the 3-year average. So you can compare crude production and say, wow, we're at 13.3 million barrels a day. But last week we were at 13.4. Are we declining? Last year we were 12.4. So we're up a million barrels a day year over year. I'm sorry, that's 3-year average, not last year, but a 3-year average versus last year, we're only up a couple 100,000. So we're kind of treading water right there. Then you can look at refinery inputs and net imports. And this is interesting on refinery inputs. We're at 16 million barrels a day, and the 3-year average is at 15.796. What's interesting is we've taken off 600,000 barrels a day of refining capacity in the United States versus that 3-year average. So our capacity is down, but our utilization is up. So these are important factors. Then you have an international price analysis. Then you have an OPEC analysis, which is currently viewing the market as a bearish stance. Then you have a CFTC. All of this, and then this is kind of cool, the news analysis. So it goes through and actually puts news through a sentiment factor and shows what is actually happening in the marketplace. Then it has a machine learning price, and current price is 6102, and the prediction is for an erosion down to 6062. The market is moving a different direction right now, but these are interesting things for energy traders. What is actually happening? A current market dynamics, neutral sentiment with the Brent WTI spread at 289 indicates a disparity in global versus US supply demand dynamics. These are important factors to know. And if you're not on top of these every single day, you're going to be one step behind. And then for those on the natural gas side of the market, we actually cover the same dynamics, technicals, fundamentals, where we cover dry production. You can see dry production 105 versus a 3-year average of 98.4. And this is the key right here, this supply demand imbalance or balance. You can see 14.9. Last week was 14.8. Last year was 8. You can see we're kind of in a bearish stance, and we have weather analysis. All this comes out every single day. So you can be equipped to understand what is happening in the market with a quick read and a quick glance over a data-rich environment where you're making decisions based upon data, not guessing, but you're making decisions based on technicals, on fundamentals, and where the market is heading, not where it is. So, why this matters. Without this resource, you're reacting late to macro shifts. You're guessing on price action direction. You're blind to key positioning trends. You're vulnerable to algo triggered price moves. So you're vulnerable to these, you're blind to these, you're guessing and you're reacting. All of these aren't good for your trading, for your selling of the commodity, or your buying of the commodity. With this resource, you're now anticipating moves, not reacting. You're seeing price setups before they hit Twitter and aligning both fundamentals and fund flows. So trading with conviction, not confusion. So this is important to understand. Bottom line, the edge in today's oil and gas markets doesn't come from trading harder, it comes from trading smarter. In other words, you can actually spend 30, 50 hours a week researching all of this, or invest in a tool that already does the research for you. It does the heavy lifting. So all you have to do is absorb that, figure out which variables, because there's a multitude of variables in here. I mean, you can go through and make your decisions based on technicals. Well, one quick glance at this and you're like, well, moving average are bearish, but I like MACD and stochastic. So I am bullish right now. And that would have been playing out very well on the crude oil markets. Same can be said for natural gas. You might look and you see bullish on moving average and MACD, but the stochastic is overbought. You may be like, this is a sell signal, and the Bollinger Bands and Williams percent R, all of these are lining that way. So investing in resources to save you time so that you can plan accordingly, so that you can make your decisions with data and with information that is important for you. So data, clarity, context, and confidence, that's what we provide. And if you go to energyrogue.com and you click which version, what I just showed you is Rogue Radar. Rogue Radar is only $89 a month, and there is a 14-day trial right now. So if you go to Energy Rogue and you click through, you are going to have access to a 14-day trial. So try it out for free. If you like it, great, use it. If you don't, that's fine, but be prepared. These are important factors so that you're prepared in the marketplace, because without that preparation, you're going to be potentially behind the eight ball. Anyway, that is all that I have for today. I wanted to say thank you so much. Thanks for joining us. Bill and I will be back together either next week or the week after. We have a little bit of international and speaking engagement, so we're kind of juggling a few things. But anyhow, thanks for joining. Hope you enjoyed, and we'll talk soon.